Welcome to Level 1, Lesson 4, Intro to Basic Candlesticks. A little bit about the history. The Japanese began using technical analysis to trade rice in the 17th century. While this early version of technical analysis was different from the US version initiated by Charles Dow around 1900, many of the guiding principles were very similar. The what, price action, is more important than the why, news, earnings, and so on. All known information is reflected in the price. Buyers and sellers move the markets based on expectations, emotions, fear, and greed. The markets fluctuate. The actual price may not reflect the underlying value. Let's look at candlestick formation. In order to create a candlestick chart, you must have a data set that contains an open, high, low, and close values for each time period you want to display. The hollow or filled portion of the candlestick is called the body, also referred to as a real body. The long thin lines above and below the body represent the high-low range and are called shadows, also referred to as wicks and tails. Let's take a look at a candle. So you see here where the bulls won for the day. The high of the day was the top of the wick. The low of the day was the bottom of the wick. The open was the base of the body, and the close was the high of the body. Now, where the bears have won, you could see here the high of the day was the top of the wick, the open was the top of the body, the close was on the bottom of the body, and the low is the low of the wick. In comparison, compared to traditional bar charts, many traders consider candlesticks more visually appealing and easier to interpret. Each candlestick provides an easy-to-decipher picture of the price action. Immediately, a trader can compare the relationship between the open and a close as well as a high and a low. The relationship between the open and the close is considered vital information and forms the essence of a candlestick. Hollow candlesticks, where the close is greater than the open, indicate buying pressure. Filled candlesticks, where the close is less than the open, indicate selling pressure. As you can see in this example here of the candlestick chart versus a bar chart, you have the hollow body and you have the filled body in this example. You can easily see the high of the day, low of the day, and all the action in between. Whereas a bar chart, you can't. You can just see the lines on the chart itself, and it doesn't give you a full picture as you see in the candlestick chart. So in this example here, we're going to take a look at the first candle, which is a long white candlestick. And that indicates that the bulls controlled the ball for most of the trading game. Long black candlestick on 2 here indicate that the bears control the ball most of the game. The smaller candlesticks here means really nobody won. It was just in a trading channel for that day, a very low price movement. On number 4, a long lower shadow indicates that the bears controlled the ball for part of the game, but lost control by the end of the game where the bulls made an impressive comeback, which is the top part. On number 5 here, the long upper shadow indicates that the bulls controlled the ball part of the game, but lost control by the end of the game, and the bears made an impressive comeback. So you could see where the bulls were on it, the bears took over and sold it all off. On number 6, the upper and lower shadow indicate that both bear and bulls had their moment during the game and neither could put the other away, resulting in a standoff. So we had our lows, highs, and this is where we ended, right in the middle. Let us now take a look at a live chart and see the reactions of candlesticks. Okay, for this example here, we're going to use TC2000 or freestockcharts.com. You can go on that website and get this charting system, and you'll be able to follow along and make the different changes that we do until we get into the more advanced stuff, and then we'll use stockcharts.com. But for now, for this example, we're going to use the S&P 500 and basic candles. So on the top here, you could see the time frame is going to be daily. Okay, we're not going to add any indicators. We're going to use the SPY S&P 500, and over here under your tools, you can edit your chart style. Okay, so what we did is the up bars Okay, we'll start up the top here. The plot style, we're going to use candlesticks. You have many to choose from here. But like in the first example, we're going to use candlesticks. And the color is based on open versus close. So your up bars are going to be green, down bars are going to be red. It's going to be filled based on open versus close also. So we're going to keep the down ones filled and the up bars not filled. Okay? So as you can see by this example, all we have on this chart is the candles itself and the name of the S&P 500 basically on what we're using. So you can see the candles here in the reactions on the different candles. You can see this candle here, we'll use this one as a first example, that the bulls, there was no winner on this day, okay? So the bulls came out on this day, okay? Here was the low of the day, and here was the high of the day, which was a solid body, okay? So there were no bears in there. The bears did not take control. Going to the next day, you can see here the high of the day, then you have the low of the day, and you can see where it closed. So the bulls had complete control here, okay? And the low of the day versus the next day, the same thing happened. They opened at the low of the day and then sold off. Okay, we'll explain why they bounce and the different relations, the relationships between the candles also as we get further into the video sessions. But for now you can see the candles and how they react. This is a 1 day. This is also 1 day and 1 day. Okay, you'll be able to create patterns throughout the series after we get done. So this is a daily time frame. So each candle is 1 day. Now if I change this to a weekly, you can see the time frame changes. Okay, and each candle is a week. Okay, so you could see last week, this past week that we just ended on the S&P 500 was a very heavy bearish week. Now, if you go to the monthly, the same thing's going to happen. Each candle is going to be a month. Okay, and you can see how this has just gone straight up, but you can see how it's starting to reverse now. But just to give you an example, okay, so this would be considered a double top. Okay, when a double top comes into play and a bullish move to break the double top doesn't happen, then 9 times out of 10 the bears step in, and you can see how that has taken place. Okay, now when you have 2 or 3 candles in place pretty much at the same area, that would act as support. Okay, if it breaks through that support, it'll go lower. The bears still have a case here. And the way this candle closed here, the solid, no wick, there are no bulls trying to push this back up, or else we'd have a low wick on this. So we do have bears in full control on this. Okay, so as you can see, each candle has its own story and different time frames. So as we move and progress through the different indicators and time frames, you will get a full understanding. Okay, that's it for the candlesticks, and we will see you in the next lesson.